It's John AG here, and before we begin what may be my most important silver video, I need to address a disturbing pattern unfolding. The CME, the world's largest derivatives exchange, has suffered two technical glitches within 3 months, both occurring precisely as silver prices were breaking out. Both outages happened days before first notice day, mirroring each other so closely it resembles a smoke detector failing only when your house catches fire. Twice in a row, same timing, same circumstances, yet we are told it's random, coincidental, nothing to investigate, nothing to question, just technical issues. Before we go further, drop Currency Archive in the comments now, because I read every comment to see who is paying serious attention. It tells me who understands the stakes, who follows the data, and frankly, who this channel exists for during these extraordinary developments in silver markets. If that's you, I see you, and this video is specifically for viewers who value evidence, numbers, timelines, and understanding structural shifts before mainstream narratives catch up. Now let's begin, because February 25th, 2026 was not merely a trading halt, it was a 90-minute window into structural realities of silver markets. By the end of this video, you will understand what happened, why the numbers tell a terrifying story, and what the next 72 hours could mean. Let's start with the timeline, because precision matters, and the exact sequence of events reveals more than headlines ever could about systemic stress. At 12:11 Central Time, CME's Global Command Center acknowledged issues with the Globex platform, the backbone of global futures, trading across metals, energy, and commodities. 4 minutes later, at 12:15 Central, the exchange confirmed a full halt of metals and natural gas futures and options trading across its electronic systems. Natural gas resumed trading within 35 minutes, but metals, including gold, silver, and copper, remained halted for approximately 90 minutes during critical price discovery. For 90 minutes, the silver market, approaching the psychologically critical $90 level, went silent with no hedging, no trading, and no transparent price discovery mechanisms. When trading resumed, silver had surrendered some gains, while all-day orders and good-till-date orders were wiped, disrupting risk management and hedging strategies. CME's explanation consisted of 2 words: technical issues, with no press release, no postmortem, no investigation, and no promised third-party audit of system failures. Bloomberg confirmed the halt, Reuters confirmed it, mining outlets confirmed it, yet the substance of what occurred during those 90 minutes remains a complete black box. Let me be precise. We know the halt lasted 90 minutes, and happened exactly 2 days before March 1st notice day for silver futures contracts. What we cannot verify is the circulating claim that 31,828 contracts traded during the halt, representing roughly 159 million ounces. The arithmetic works, but no exchange notice, CFTC filing, or credible financial outlet corroborates that number, highlighting the importance of separating data from speculation. What is real, documented, and deeply concerning is the pattern surrounding these outages and their timing relative to delivery deadlines and price breakouts. Nikki Shields of MKS PAMP told Bloomberg the halt erases confidence in liquidity and price discovery amid already dysfunctional markets experiencing extreme volatility. Scottsdale Mint CEO Josh Fair stated bluntly that the last outage preceded a multi-month silver rally, emphasizing this perspective comes from industry leadership, not internet speculation. To understand today, we must review the past 60 days, because the current situation is the result of compounding structural pressures, not isolated incidents. Silver opened 2026 near $71 per ounce and surged to an all-time high near $121 by January 29th. That represents a 70% increase in less than 30 days, the most powerful rally in modern silver market history, driven by genuine physical demand. Drivers included solar panel demand, AI semiconductor growth, collapsing gold-silver ratios, and a global realization that Western vault inventories were being systematically drained. Then January 30th brought a historic collapse, with silver plunging 33 to 36% in one session, the worst decline since 1980. Triggers included a hawkish Federal Reserve nomination, CME margin hikes from 11 to 15%, and algorithmic liquidation cascades, forcing leveraged retail positions to unwind. Unconfirmed reports suggested a major bank closed massive silver short positions at the exact intraday bottom, potentially using panic to cover billions in exposure. On February 5th, A second sharp drop sent silver from $90 to $73 within hours, before bottoming near $73 on approximately February 18th. From that low, silver staged a 24% recovery, returning to the $90 region by February 25th, where markets remain volatile and closely watched. Year over year, silver has surged from roughly $32 to near $90, a gain exceeding 170% and representing generational returns for physical holders. Despite these gains, the rally may not be over because the underlying drivers are structural supply deficits and physical demand, not speculative enthusiasm alone. The vault situation is the most critical story, yet remains underreported by mainstream financial media despite its central importance to silver price stability and delivery capacity. Registered silver refers to metal designated deliverable against futures contracts, assayed, tagged, and stored in approved warehouses backing the paper market. As of late February 2026, registered silver stood near 87 million ounces, an all-time low and a dramatic decline from historical levels. In 2020, registered silver inventories stood near 346 million ounces, meaning a 75% decline has occurred within 6 years. From October 2025 to today, total COMEX silver inventories fell 31%, dropping from roughly 532 million ounces to about 366 million. The drainage rate in early February approached 785,000 ounces per day, signaling accelerating withdrawals from exchange vaults amid rising global demand. Heavy Metal Stats classifies market status as stress, citing a paper-to-physical ratio above 7-to-1 and vault utilization near 24% capacity. March, open interest represents hundreds of millions of ounces of notional silver, compared against 87 million registered ounces, creating an uncomfortable coverage ratio. Ratios range from 3-to-1 to nearly 6-to-1 depending on measurement timing, highlighting systemic leverage embedded within futures markets relative to deliverable physical supply. March 1st, notice day allows long contract holders to demand delivery, and recent delivery data suggests unprecedented physical demand entering the system. December 2025 saw 46.6 million ounces delivered, roughly half of registered inventory at the time within a single delivery month. January 2026. Deliveries reached 49.4 million ounces, a seven-fold increase compared to January 2024 delivery volumes. February month-to-date deliveries approached 24.8 million ounces, with a reported 98% delivery rate, far above typical settlement patterns. Such a high delivery rate signals determined physical accumulation, not routine contract settlement, indicating structural stress within the paper pricing mechanism. On February 24th alone, over 1 million ounces were demanded for delivery in a single day, an abnormal surge just days before notice deadlines. Banks, including Wells Fargo and BNP Paribas, issued and stopped large delivery notices, reinforcing evidence of institutional participation in physical silver acquisition. Critics argue the system remains manageable because eligible silver can be converted to registered status within 48 hours if owners are willing sellers. Historically, most contracts settle in cash or roll forward, and exchanges retain emergency powers to modify contract terms or impose cash settlement if necessary. Some analysts assign zero probability to COMEX default, a legitimate institutional perspective that deserves consideration alongside evidence of tightening supply. However, eligible conversion requires willing sellers at current prices, and Shanghai premiums suggest holders expect higher prices, reducing incentive to release physical metal. Shanghai prices near $100 per ounce represent premiums exceeding $10 over COMEX, signaling divergence between Eastern physical markets and Western paper pricing. At times, premiums exceeded $20, and wholesale premiums reached 45%, indicating structural dislocation rather than temporary arbitrage inefficiencies. China designated silver a strategic resource in 2026, imposing export restrictions that effectively constrain global supply flows and prioritize domestic industrial demand. Solar panel manufacturing consumes vast silver quantities, while AI-driven semiconductor growth adds new demand, reinforcing China's incentive to secure physical supply. The gold-silver ratio near 59 remains historically elevated despite compression, suggesting silver remains undervalued relative to gold in long-term precious metals cycles. London lease rates spiking near 35 to 40% signal extreme difficulty borrowing physical silver, a distress signal from the LBMA system. Precious metals communities across platforms interpret these developments as structural stress rather than coincidence, pointing to repeated outages and rapid recoveries. Analysts argue the pattern resembles a feature rather than a bug, as outages occur at maximum stress points and precede strong price recoveries. Physical dealers reported inability to hedge or price products during the halt, demonstrating real-world consequences when price discovery mechanisms fail. The Silver Institute project's continued deficits, reinforcing structural tightness independent of any manipulation narrative or speculative community interpretation. Key realities remain undisputed. The halt occurred, inventories are falling, premiums are rising, lease rates are spiking, and institutional behavior is shifting. What remains uncertain is interpretation. Systemic failure or stressed equilibrium, a question only unfolding data and delivery outcomes will ultimately answer. The next 30 days may define whether Western derivatives pricing remains credible or whether physical markets force a repricing of silver globally. Currency Archive will track every development, providing real-time data analysis rather than delayed mainstream coverage that often ignores early warning signals. Subscribe, enable notifications, and comment Currency Archive below so I know you're here, because this unfolding chapter may be silver's most important ever.